Good day, fellow investors. Let me start by saying that I'm not here predicting anything. I cannot know whether stocks will crash tomorrow or not. What I always want to say is that whatever happens, I want to do well from a financial wealth perspective. Yes, if we look at the stock market at the current valuation level, each time historically things have looked similar, the consequent decade-long return has been a negative plus 60% real returns. We are now here. I don't know whether the market will crash or not, but I want to do well if the market crashes over the next decade, and I also want to do well if the market doesn't crash in the next decade. That is the key of value investing. Always doing well. Not just doing well when the market does well and then forget about those decade, 2 decades when the market does terribly. If we look at the S&P 500, at the price to earnings ratio, well, that's now at 30. Just a return to the historical average of 15, just that, all else equal, economy doing good, interest rates stable, just this return would mean a 50% crash of the S&P 500. Now, whether that will happen, we already said we don't know. However, we have to ask ourselves and find the answer to the question, if the market crashes, do I keep on compounding my wealth? Yes or no? If I look at the S&P 500 dividend yield, which is 1.2%, if I look at the historical earnings growth over the last 25 years of 5% per year, the best the S&P 500 can offer me is 6% returns at best, all else equal, money printing continuing, no recessions, etc. Worst case scenarios, we already discussed the P/E ratio returning to the mean. If investors expect higher dividend yields, the market can crash 50 or more percent. And the fact is that even if the market crashes 50%, let's say dividend remains equal, then the dividend yield goes just to 2.5%. Your, based on the current price, dividend yield will still be 1.2. But when you are reinvesting that 1.2% or 2.54%, even at market lows, 50% below where we are now, 2.4%, 1.2, even 3.6% yield, which would imply a 60% crash of the market, doesn't help you at all. On buybacks, as many of you will ask, well, if the market crashes 60%, then 60% of the buybacks done at these levels are going into smoke, money into smoke. My strategy is basing investment over my life investing cycle, which lasts not a bear or a bull market, but hopefully a few cycles and hopefully more than 5 decades, is to always base things on fundamentals. And that's exactly what the focus of my research platform is. We focus on finding value with a margin of safety. We've been doing around 14% for the last 7 years. Based on that value investment perspective. And I've started just updating for September the curriculum there. And one of the good examples I have much better is Amsterdam commodities here. It is a diversified, plant-based portfolio, spices, nuts, thus defensive, and it has been growing 8% per year over the last 2 decades, I think. And if I make a valuation, if I look at the P ratio, the P ratio of the company is still 9. So 9, dividend yield 6%. And given the business, the stability of it, I'm pretty sure that in whatever environment, whatever the market does, this business will keep on growing, keep on producing cash flows and earnings as it has done in the last 20 years. Now, this doesn't mean that the stock here at 22 euros might not crash and go to 15. That is also possible. But if it goes to 15, maybe there will be a dip for a year or two. But then the dividend yield might be even 10%. and then with a 10%, let's say, reinvesting yield on current market, I might be even buying the S&P 500 if it crashes 60-70%. I have the money to reinvest and build my wealth in these lost decades that often happen. And this is where you want to keep on compounding, not just in bull markets. So my strategy is to own good businesses that have good valuations, stable dividends, great growth. And for that, that's why I have a research platform. For that, you need to do research and you need to find those. And let me compare this with the S&P 500. P ratio 10, P ratio 30, dividend yield 6%, dividend yield 1.2%, earnings growth 8% over the past 2 decades. If we look at the earnings of the S&P 500 over the last 25 years, if I just look at the numbers, that's adjusted for inflation 3.2%, add 2% inflation, 5% growth in a great environment. So this is my strategy for, let's say, whatever is going to happen in the future. And this is something I would not like to have exposure, these kinds of risk in my portfolio. But as I said, I've done my 14% over the last 7 years, done even better in the past, and the market did also greatly. But based on fundamentals, I think I can keep on doing my 10, 15, even higher percent per year despite what the market does. That's the value investing strategy. That's the main message of this channel. So, basing my investment returns on fundamentals. Check my research platform, check my portfolios, 21-day money-back guarantee. Thanks for watching. I'll see you in the next video.